This video is to discuss what determines the valuation of any currency out there. So mainly there are two methods which decide the valuation of any currency, through which the valuation of any currency is decided. So the first method is the fixed method. In the fixed method, the government decides the valuation of a currency. So till 1993 in India, the valuation of Indian rupee was decided by the government of India. Second is the flexible method. In the flexible method, the valuation of the currency of a country is dependent on market trends. There are various market trends which we would discuss at some length in this video. Or in some cases, there is a third method which is called the managed method. In this managed method, the valuation of a currency is again decided and depends on the market trends, but the government of that country sets a limit of fluctuation. Is that the government sets up a limit in which it's a range of 5 to 10% between which the fluctuations can take place, the fluctuation of the market trend can take place. Now the factors, the market trends which affect the valuation of a company are as follows. So the first and main factor which determines the valuation of a currency is called foreign reserves. So, what do I mean by foreign reserves? So, foreign reserves is the amount of foreign currency held by banks of any country. So, if we take case of Dubai, Dubai has a whole lot of oil reserves, and oil is always in demand by the countries all over the world. So, Dubai is always getting foreign currency from other countries. Now, the second factor is, and yeah, because it gets more foreign currency, its foreign reserves are getting higher, thus making the dirham, the currency of Dubai, a whole lot stronger than even US dollar. The second is current account deficit. So, current account deficit is nothing but the difference between the import and export of a country. In case of India, an importing country, the value of import exceeds the value of export, because of which the current account deficit is higher, thus making the value of Indian rupee weaker. The third factor is demand and supply of currency. In case of Zimbabwe, the government and the banks out there just started to print excessive notes in the country, thus increasing the supply of the currency notes in that country. But because the demand was stagnant, the currency of the country started to fall. The currency became much weaker now. The fourth factor is inflation rate. So if we take inflation rate to be 6% and US inflation rate to be 2%, then the difference between the inflation rates of these countries, that is 4%, will make Indian rupee 4% weaker. But on the other hand, if Indian inflation rate was 2% and the US inflation rate was 6%, then this 4% difference would make Indian rupee 4% stronger. Now we come to the fifth factor, which is the interest rate. If the government bonds, the government companies, the private companies are offering higher interest rate to foreign investors are likely to invest in these Indian companies, thus giving them more returns. As these companies give higher interest rates, India will attract more foreign currency to its country, and thus increasing the foreign reserves, thus making the currency of its country higher. Now, the sixth factor is the stock market. If the stock market of India is performing well, then again it will attract more foreign investment, higher foreign reserves, and stronger the currency of the country. But if the stock market of India is terrible, it is not performing well, then it won't naturally attract more foreign investment to India, and the existing foreign investment made by foreign investors in the country would naturally be drawn back, would be taken back by the foreign investors. And also the value of currency in that country depends on the stock markets and performance of other countries. Say if China is performing well, it's giving lower, higher interest rates, and then the foreign investors would be naturally driven to invest in China than investing in India, thus affecting the stock market of India, thus making the currency of Indian rupee weaker. So these are the factors. To summarize, two methods through which the valuation of currency is determined. First is the fixed method, and second is the flexible method. And various market trends are firstly foreign reserves, demand and supply of the currency, then current account deficit, inflation rate, interest rates, and stock markets of that country and that of other countries. So I hope I was able to add some value to the precious time you spent in watching my video. See you in the next video. Till then, bye bye.